What's going on, guys? Welcome into another episode of Money Moves. As always, your host, Matty A, my co-host, Mr. Ryan Breedwell. Today, we are covering a lot of different topics, why a projected $64 trillion national debt changes the long-term math for every asset class, the contradiction inside the latest CPI and jobs data, and what that means for the Fed policy and rate cuts going forward this year. A quiet housing market signal that looks eerily similar to 2020. We'll talk about that. Why Goldman Sachs is holding $2.3 billion in crypto, and really why that matters more than the meme coin headlines that you are reading. Whether Elon Musk is turning X into a crypto platform. This is a big break in news this week. We've got the hidden risk inside rising bankruptcies and delinquencies, a potential S&P 500 black swan warning from quant models. We'll get the real scoop from Mr. Breedwell, and the uncomfortable conversation around politics, meme coins, and investor trust, and really how that's impacting the market as a whole. We're going to dive in today's episode. Well, something isn't adding up. We got inflation is cooling, Mr. Breedwell. Jobs are looking strong, yet debt seems to continue to be exploding and building month over month. We're starting to see maybe some cracks, maybe not. I don't know what we're feeling and seeing overall in the market based on some of that data. So we're going to dive in. We'll zoom out. We'll connect the dots on what actually matters this week. Get your insider intakes. I mean, on the surface, the economy looks and feels stable in a lot of ways, right? We've got inflation came in cooler, unemployment dipped, the headline job growth beat expectations. And then at the same time, underneath all of those narratives and all that data, there's a lot of uncertainty and a lot of fear and a lot of doubt, I think, that people are feeling right now. The U.S. national debt is now projected to surge by $2.4 trillion per year. That number just seems and sounds crazy to say out loud. Corporate bankruptcies are rising. They're hitting crisis era levels, at least based on what we've seen in previous, crisis. Credit card delinquencies are rising, and the housing market just recorded its biggest monthly sales drop since 2022. At the same time, we've got Goldman Sachs is quietly loading up on crypto. We've got Elon Musk maybe turning X into one of the largest crypto on-ramp platforms in the world. I'm excited to hear a little bit more about that. The real estate giants are trading like we're back in 2008. So I don't know if this is just noise, if this is structural shifts in policy and capital flows and investor psychology that's, going from an old guard and way of doing things to the new world. There's a lot we're going to break down in today's episode. So first and foremost, how are we doing, my man?
Doing great, man. Doing great. Little cold and wet here in Northern California. And Matty and I and some other friends are headed up to the Truckee area this weekend to my cabin to hang out. And I'm excited to see about, I think, like 4 or 5 feet of snow by that time.
Dude, I mean, it's going to be a historic snowstorm. So
very excited.
We were just joking a week ago. I mean, we were running around in tank tops and shorts and sweating coming into the studio. It felt like springtime, and now we're all bundled up and it's raining. I mean, cars are always joke. Like, it's funny how when, whether it's a snowstorm or a rainstorm, like people just seemingly forget how to drive. So there's a lot of drama going up over the pass into the mountains, but we're excited to get up there and have some fun with the families. We're going to have an 80s night that we're getting all dressed up?
Yeah. You and I I think are getting our outfits for that now. We'll have a little bit of a lot of fun. We're going to do lots of cooking. I was telling us, like, the snow is honestly good because it'll just keep us inside.
Yeah.
Maybe we go downtown a little bit, have a little bit of, shenanigans, but it's going to be a fun time. Really good time hanging out, and that's what life's all about.
Yep. I'm excited to spend time with my girls, spend time with my beautiful wife, spend time with my favorite friends. So looking forward to that. So let's dive in kind of with the, we'll call it the first topic. U.S. national debt projecting hitting 64 trillion by 2036. I mean, that just sounds astronomical. I mean, you continue to hear more and more people talk about. I think it's easy to kind of be like, well, it is what it is. It's going to continue growing. It's always continued to grow. And yet, I think about our kids, right? I think about our generation. I think about our kids. I think about our grandchildren. And like, what does that actually mean for them? I mean, I think this is probably, in my opinion, one of the most structurally important stories to at least just pay attention to. Like, is it going to blow up in our face today? And as Ray Dalio says, the end of an era with this debt cycle and empires falling and being as doomsday as some would like it to seem. I like to think not. You're really good at speaking reason around this. Obviously, debt affects rates. It affects real estate. It affects equities, currency dominance, long-term purchasing power. These are all real things that matter. So, my question is more around with, debt set to surge 2.4 trillion per year over the next 10 years. As a result, U.S. debt is going to continue to grow and grow and grow. Is this of real concern in the short term, midterm, or long term from your perspective? And how does this impact investors, being that we've heard more and more people talk about potential crashes or a reset because of this? Talk, nuts and bolts here and the truth from your perspective.
Yeah, I think that the rising number, like I said, if it's not uh, serviced or good debt, it becomes really scary. I think that if a lot of individual or retail investors saw the balance sheets of a lot of the really big investors, how much debt they hold and the tax benefits to it and what it does and this and that, I just think we're going to come out of that. I think that what the assumption is when we see runaway debt kind of being preached and there'd be a huge reset and stuff, it assumes that nothing changes.
Right.
And we just continue to compound that forever, which I just don't see that being quantifiable. And I think what the other thing that people forget to consider is that we are in kind of a new era of AI and stuff. And we need that money now to invest in the technology to create the earnings then. And that requires debt. And we are trying to be the world center for that, not only for AI, but for crypto, for microprocessors, computer chips, all that kind of stuff. And so that requires a lot of capital up front. And I think what will eventually happen, it'll come back into tow and we'll have a GDP that will offset that via payments, via refinances, via debt restructure deals with other countries for military goods. There's things that we can do to change that. So yes, if a fire is left to burn, it will do so. I just don't think that this is a fire being left to burn. It looks like it maybe from the surface, but there's a lot of smart people in the background that know how the mechanics of things like this work. And I would say in the long run, it's going to be fine. And I don't have any fears in the short term either.
Yeah, I mean, I think it's one of those things where I think we have more runway than, some people, when they read and hear some of these talking points, think like, oh my gosh, it's going to happen next month, right? Or it's going to happen, next year. It feels sometimes closer than maybe it actually is. And who knows? I mean, at the end of the day, anytime a black swan event happens, like it happens when nobody's expecting it.
Right?
Yeah. So, I mean, it could happen at any point in time.
Yeah.
That being said, let's zoom in for a second. And I try and read in the tea leaves, like what's really going on. And the best thing we can do when it comes to, trying to get a pulse on, what's accurately going on is kind of zooming into more of the current, at least most recent data, right? And so like when we zoom in on what's really going on in the economy, obviously debt is a massive component of our economy, the global economy as a whole. And the debt is something that I think we do for sure have to continue to pay attention to. And I hope I'll say it nicely, maybe not. the fucktards on, in DC actually start to pay attention to the fact that these blank checks that they're writing, these omnibus bills, and the egregious amounts of money that they're taking of our hard-earned tax dollars and what they're allocating it to, and at the levels they're allocating it, is not sustainable, right? I mean, you've heard some of the smartest economists and business owners in the world say it's just not sustainable. And so hopefully, that this will resonate and settle in at some point. And maybe it won't. Maybe it will take a major crash, a great reset, a great depression. I don't know. I hope that doesn't happen. I'm gonna bet that we'll figure that out before it does happen. And at the same time, I'm also going to prepare and plan and, be somewhat hedging my bets along the way, being that we are where we're at in this, state of the current situation. But let's just zoom in and let's look at a little bit more granular data of like what could maybe shed some light on what's actually going on today. So let's talk about the jobs, right? Jobs is, I think, a big one, and the strength of the consumer, the strength of our economy in terms of how many people are working and making money and contributing to society and feeling productive in society. We just saw U.S. jobs were revised down by 1 million, which was the largest revision in decades. How much confidence should we place in headline data like this if revisions this large, which we've seen whether it's under this administration or previous administrations and many previous administrations after that, how much confidence should we place in headline data if revisions this large are becoming a little bit more normal? Like, is this just statistical noise that we should just be like, it happens, give and take. Maybe this month it's pretty big. Other months it gets made up over time, right?
I think the seasonality is playing into that one with such a large number. There are a lot of temporary jobs that aren't reported as temporary, and other temporary jobs are baked into that number for some reason, even though they are known as temporary.
Yep.
So it's just not, right now, that data point doesn't surprise me, nor is it something I worry about. And they're not, those points of data are to use as like guides, but they're not perfect. I mean, look at the Fed futures that we look at and how big they swing from day to day. They give us an idea of where the sentiment is, but not necessarily what's going to happen.
Yeah.
And we saw that in the 2016 election. We saw that in this last election, where people thought there was momentum where there wasn't, and we ended up seeing a surprise. Hence the re-election of Donald Trump, and then the election of Donald Trump is what I was referring to. And then in 2020, the surprise shock that there was another person potentially voted in. So that, to me, data points are a good idea. Polls, opinions, price targets. It gives us an idea of where people's gut is, but nothing's perfect because it's all kind of a guess.
Right.
It's educated guess, I guess you could say. A guess. If I say guess again, I get $100. So I'm not too concerned about it.
Well,
I'm of the opinion, like I said earlier, when you said 7,100, 8,000 is kind of the range. I'm around 7,600, and I hope that I'm wrong to the upside, which I have been. And I just don't think, I think there's just a lot more going on good than the one or two things that could go bad. And so in financial planning and investing, we plan for what we know today so we can be prepared for what's unknown tomorrow. We don't say what's unknown might happen today, so let's act like it and just wait to be right. That's what happens when that's the analyst that sits around and calls for a recession every year and is right once every 7-10 years.
Yeah.
And then rides their horse into the sunset.
That sounds...
It's just easier to be... It's okay to make these guesses, these educated guesses, understanding we're going to be wrong, understanding investing, part of it is losing money, and knowing your risk.
Yeah.
That's simple.
Well, and I think to the contrary of that point, right? And the jobs revised down. Let's just talk about this month. I mean, January jobs beat expectations. Instead of 55,000 in unemployment, we saw 130,000, which unemployment dropped to 4.3%, showing a stronger labor economy, right? And then we saw core and CPI drop down, which to the lowest level in years, right? So, I mean, despite the Fed's claims and assumptions that have come out from Powell that, inflation is heating up, it's actually trending lower.
The data says the opposite.
The data says the opposite, right? So US CPI is now at its lowest level since April of 2025, right before when tariffs were imposed. A lot of people said tariffs were going to be massively inflationary. What we've seen not only through this season of tariffs, but previous season of tariffs, that historically it's shown it's actually deflationary. So obviously that, puts the Fed in an interesting position that they're going to have to start cutting rates. I mean, when we saw this data come out last week, you and I were going back and forth going like, yeah, we thought there were going to be, one or two cuts, that we've been talking about for sure on there. Is there potential for more cuts based on some of the data that we're seeing early on in the year?
No, still the same. I think I took the futures pretty recently, and we're looking like a June, July time where we have a higher percentage of a cut, and then sometime around the September, October, November time, which would line up with very similar cutting schedules as last year. And my guess would be they'd be 0.25% cuts, and we would get 2 more 0.25% cuts, and then we would pause and likely leave rates there for the long term. Of course, without knowing anything that could happen in the future, like a black swan, which then we may need to inject capital back into the economy to keep it healthy. And the best way to do that is lowering rates because people will borrow. So that, you have to understand we're a debt-driven economy to understand why we have so much debt. That's one of the reasons we work so good. And that's why, very wealthy individuals use debt as their income backing. They don't pay a lot of taxes because they're using their stock to offset their income. It's just with loans. It's just, excuse me. It's just what the wealthy do. They use debt and leverage money and use it to their advantage. And they say, yes, I'll pay this person to use their money because then I can keep my money on hand and I'm making, positive arbitrage still. I'm making more than than it costs me on this dollar.
Well, speaking of the dollar, right, it's been floated out there for years now, BRICS, and the,
news.
your big nothing burger news, the concern about, these countries going away from the US dollar. We've heard recent, news and headlines come out about the devaluation of the dollar, and there being concern about, the dollar remaining the reserve currency of the world. This is how quickly things can change or, enter the room in the narrative, which this last week, Russia has now very publicly stated that they are considering returning to the US dollar and partnering with the United States and the Trump administration and transacting in US dollars and coming back in a way that really took a lot of people by shock, right? So, I mean, and yeah, right? I mean, I think to your point,
it's not going to happen.
So does statements like this signal dollar resilience despite geopolitical tensions and whatever hot headline enters the room that day or gets up on the teleprompter of the news station that day? Like, how much of de-dollarization is narrative versus actual measurable capital flows that are threatening the strength and the dominance of the US dollar?
100% of it's posture. None of it will ever come to fruition. We're way too far down the path of...
It's kind of like you're already pot committed, right? Like you can't unravel how many people have intertwined their economies and the livelihood of their citizens in the US dollar.
It's like the China-US relationship, It's like built on necessity, or else I don't think it would exist like it is. if we weren't so deep in each other's manufacturing strongholds, I mean, we need China because we don't have a better option yet.
Yep.
Working on it, but we don't have one yet. And China needs us because they don't have a consumer level to support their population. So without the US, China fails from an economic standpoint. But without China, the US fails because consumers would be pissed because they wouldn't be able to consume as much as they want to. So it's this double-edged sword we walk. And most of the stuff is posturing for political purposes, in my opinion, 90+% of the time. And especially when we're talking with USA, Russia, USA, China. But China is just notorious, not really a good partner to have long term.
So we were talking about Black Swan previously. And we've also, I know this has been in your world for quite some time. I think obviously people are understanding and learning more about what this word means and how it kind of ties into, call it the financial world or just the investing world in general. If you're, not an institutional player, you probably haven't heard this word as often, but it's becoming more commonplace, which is, quant models and AI and a lot of the, interface in the financial world. That's been around for some time, correct?
Yeah. They're just essentially, they're better mathematical representations of kind of what's going on at a very high level back with and this, I don't know if everybody remembers like imaginary numbers back in high school. We're talking like that type of math, and they use math and equations in non-biased ways to crunch numbers from its top up, bottom down, and then through, meaning it's a whole nother way to process the data. Including volume and price. I mean, everything, just things that we don't normally consider, all wrapped into one. And it allows people to make decisions extremely quickly. And really where I see it being the most prevalent is automated trading and automated trading models or automated purchasing or pricing. We see it in very low level deployment when we see like releases of collectible or high demand items with botting. And you see these bots go in and they know code that indicates that there's something releasing, and they go and do multiple purchases extremely fast at levels that will get, pushed through. So we see that with what's called botting, right? And that's a very low level of an automated idea. But if that can get applied and ramped up to trading, similar to high frequency trading, but just done in a way where it's purchases and sales at the perfect time, that can translate through to very positive outcomes for investors. And there's very low levels of that right now, including what we use, but nothing to the scale of what people would like imagine, something like almost out of the Jetsons, right?
Yeah.
It's not
Yeah.
perfected yet.
So this last week on X, and this kind of ties into the question, shout out to Mr. Casey McCoy for reaching out and asking his question. This is based on a post that was, something that he engaged in. And it really ties into, I think, your overall, thesis, right? This post basically says that everyone is bullish on 2026. That's from Oppenheimer, Deutsche Bank, Morgan Stanley, UBS, Goldman Sachs, JP Morgan, Bank of America, all giving their targets for year end by, on the low end, 7,100 all the way up to 8,100. I think you mentioned 7,600, right?
Yeah.
And that's a pretty overwhelming consensus from what you would consider some of the smartest and most resourced and insightful institutions that drive where, the world goes in terms of finances. And this guy overall has basically said that he believes it's going to be a negative year for the S&P 500, not just a single-digit pullback, likely double-digit downside. Not a ton of data to support that. However, this week on X and financial Twitter, quantitative algorithmic trading models are predicting a major S&P 500 black swan event within the next few months. Now, again,
not a black swan.
say it again.
doesn't that make it not a black swan if it's predicted?
Yeah, I guess,
I
right?
think the wind out of people's sails.
By definition, you would think so, right? But who knows what these quant
It's
models
almost
are?
like
It's semantics,
like
right?
November
Semantics
of
for these quant
2019.
models.
Our models are predicting in March of next year there'll be a black swan event with the virus. It's like, I mean,
So I guess
so like that's just
my question to you is, coming from the financial world who cuts through a lot of this noise and kind of the headline BS, right? And also leveraging and utilizing in some capacity quant, algorithmic models and kind of how they help provide more context, more data. Are quant warnings like this, whether it's good and or bad, predictive? Or do they amplify volatility by shaping behavior because of some of this insight that they're feeding into the, ecosystems that push these narratives? Like, what would actually qualify, as something from a quant that I guess warrants concern and or conviction when it comes to something like that?
um it's hard to say because it's almost like
And have you heard this headline at all? Like,
right now there's always somewhere between a 20 and 30% chance, at least where the market sits today, of what we would consider a recession.
Yeah.
But risk is always there because volatility is present.
right?
So that's not anything that should be concerning or new or surprising to investors. I think the thing that is just old for me is the constant trying to predict that something's going to go wrong. Something's going to go wrong, no doubt. I have no idea what, I have no idea when. Um, but it is, or they is. So I don't know why we're trying to be predictive and avoid it. It's like it's the equivalent of going to a casino and like walking up to a slot machine and pulling and going, this is the jackpot. Like knowing that level. We just don't know. We don't know. And it's more statistically favorable from a psyche standpoint to just understand the risk, know that that represents opportunity long term, and not worry about the short term because the same people calling for a recession or the market up or what have you have a very easy to understand study that says short-term fluctuations in the market tend to not really matter long-term. As long as you stay invested, they just don't.
Yep.
So focusing on them, although what the headline financial news tries to tell us, because it's the easiest thing for them to bite on, it really doesn't serve a purpose. It just sparks emotions and can make you make decisions that are not good for your um, long-term investment, like growth and capital preservation and risk budgeting. All that's already baked into it. We know we're going to take losses at some point. It just doesn't mean you sell when you have paper losses. It typically means you hold and double down on the stuff that's quality and at a good price. Because we were buying, a lot of times people go, oh, hey, we bought, stock A at, 35. It was trading at 80 and now it's back down to 50. Why don't we sell? I said, because we were buying it back at 50 still. Why are we selling it? It wasn't a good time to sell it then. It ain't a good time to sell it now. People just overcomplicate investing. And I don't want to shoot myself in the foot and go out of a job. But, I just don't get emotional. It's really that's half the battle. The other half is just making the right decisions on the investments. That's the harder part. But really the easy thing is just not getting emotional. But because it's low hanging fruit, people tend to attack that first and then make emotional decisions.
Yeah, 100%. So we've got some shifts happening in the crypto world right now. Biggest stuff obviously is more and more big institutional players not only expressing interest, but now they are disclosing that they are, either actively transitioning into the space, exposing their customer base to the space, or they're actively holding themselves in the space. This last week, we saw Goldman Sachs came out and said that they have over 2.36 billion in crypto, kind of a diversified bag across Bitcoin, Ethereum, XRP, and Sol. And obviously, I like to take note of what the big boys and big girls are parking capital into. We talk about crypto being a very volatile space, an evolving space, and yet there are some of the big cap coins like the Bitcoin, Ethereum, XRP, Sol, right? And there's a few more on that short list of kind of the early solidified,
Big
again,
boys.
still volatile, but maybe a little bit more insulated to that volatility. So those are some names, obviously, to pay attention to. Does institutional balance sheet exposure like this change the risk profile of crypto in some of these types of coins long term when you see big institutions like that not only coming into the space quietly, but now starting to talk a little bit more about their bag holdings?
Yeah, and I think the weird thing is we're seeing, a peak in crypto volatility across the board.
Yep.
Right in the face of what I would call the thing that should ease it the most, which is institutional adoption and public institutional adoption, and not just pussyfooting around with $10 or $20 million, billions of dollars.
Billions.
And
For them, that's chump change at 2.3, right?
yeah, exactly. Still small amounts of money, but big, small amounts of money. Billions of dollars is a serious investment. So that's the interesting thing with, again, how investors choose to move. I still feel the same way I feel about Bitcoin, although I can jump on the, digital gold train a lot more than I can it being, replacing the US dollar. And now I'm going to fucking wave my W flag. Told y'all it was never going to be that. Nobody really talks about that anymore. Seriously, at least.
Yeah.
I don't, when's the last time? Probably well over a year and a half. So that one was pretty obvious. Could it be used as a reserve, a digital reserve, something? Maybe. Yeah, that's being floated. That's a little more realistic. If gold can do that and we can put it on an ETF, we can make something that's physical, not real. We can make something that's not real, just more synthetic and easier to trade and call it backed by. And sure, if people want to do that, that's fine. Derivatives exist for a reason. But I'm really excited to see the implementation of cross-border payments like with XRP and Ripple. The implementation of blockchain into the financial system with Solana and Ethereum. Those are the things that excite me more than digital gold. And I think what's going to happen is people are going to slowly but surely continue to adopt Ethereum more and more and more as they are. Not that they're not buying Bitcoin. And I think that's going to keep Ethereum pushing itself more and more until it is at the forefront. And when Ethereum goes to the forefront, you'll see Solana tail it. And then you'll also see Ripple kind of go behind that and maybe move more in lockstep with Bitcoin, because Bitcoin being a reserve is more of a currency-like item. And so if XRP is going to be moving currency, maybe they have some pegging to each other. I don't know. This is all just speculation. But that's the way I think about where crypto is and where it's at and where it's going. But I'm most excited for Ethereum, Solana, and Ripple and XRP.
I love this dialogue though, right? Because obviously, like you said, it's all a theory at this stage, and yet there's some real cases to be made for exactly what you're saying. I mean, a lot of things, pretty much all the big cap coins are all, for the most part, coupled and tied to Bitcoin, right? The father of the industry. So when it goes
very rarely do we see break. Like last week, we saw Ripple run while everything was going down, but it has to be on like specific news to that
correct
project, coin, currency, crypto, whatever you want to call it.
Like real tangible, trackable.
Just like most everything moves in lockstep with the S&P 500, but rarely we'll see small caps or the Dow like we did a few times last week. That same relationship would be kind of on par.
Yeah, and so I think obviously Bitcoin goes up or ETH goes up for the most part, right? The industry somewhat follows it down. Same thing. We saw the Clarity Act kind of stall out, being that I think it was Coinbase and Brian Armstrong, who really are kind of championing the overall legislation between the White House and a lot of the politicians who are kind of like trying to set the I guess we'll call it pour the foundation for crypto regulation through the Clarity Act. There's a lot of stuff in there that, call it the crypto OGs and kind of pioneers of the space didn't like. The overall, reason for the crypto industry and kind of being somewhat decentralized and outside of the control of the few and the powerful, like we see in many other aspects of the financial worlds, is still getting hashed out right now. I still am going to stand on my, my conspiracy or out there theory around some synthetic manipulation around compression across the board for the crypto industry. Obviously, we see all-time highs in, the housing markets, in the stock market, in the precious metals market. I mean, we can go down the list, and ultimately crypto is like down in the fucking dumps right now. And I think that is somewhat by design. I mean, you can go back to the 4-year cycle and you can talk about we somewhat are still following the 4-year cycle and being in a quote unquote, bear market right now and, still trying to find the bottom and working through that. But I also think there's some other powers at play here that if we are making this major transition and adoption into the crypto world, which we've seen with many of the, big institutional players of the globe now having their sights and their narratives positively set around this transition or at least more exposure into the crypto world, they're not going to want to come in, when it's juicy and frothy and they're going to FOMO in. I mean, these are the smartest people and institutions in the world, and therefore they want to get the best basis as possible coming into this space as well. So I think it's a very opportunistic time for crypto, even though it feels very bearish and grim and dark. I think, like, as you've always said, right, these are the best times to buy and at least kind of find some exposure into it. I mean, and I think, institutional adoption, while it can create some of these wild headlines that maybe, lead to some volatility, I also think the more and more institutional adoption that we do see can also dampen that volatility rather than amplify it. So it'll be interesting, but we did hear, from Goldman Sachs this week, which I thought was very interesting. One thing that I do think that hurts the industry, and, call the Trump family, entrepreneurial and opportunistic, and you can't knock their hustle and their grind for finding ways to make money. I'll leave it at that. That being said, I also know that, some of the stuff they've done in the crypto world, I think I don't know if this is, let's just call it a couple $2 billion that they've made just this year, the Trump family off of crypto. But many of it has been in ways that have been like, you got Trump coin and Melania coin are both down 95% from all-time highs. And they really kind of call it what you want to call it. I think they, leveraged the narrative and lured in maybe some naive and unaware patriots, some of their voting base who didn't know the first thing about crypto into buying some of these, worthless crap coins that have all relatively, lost all their value. I think those are some of the things that hurt the industry. So I'm hoping some of that stuff gets cleaned up because I do think crypto has a lot of utility. It makes a ton of sense. It is for, the people in a lot of way. And I think, levels some of the playing field. And there's a lot of benefits to that. But when you see whether it's, the president of the United States, doing stuff like that, or you've got, Barron Trump doing an anonymous rug pull or things along those lines, right? And again, they're just one culprit of many that do this rampantly throughout the industry. I think those are the things that hopefully will get cleaned up over time through some regulation, through some, legislation that hopefully will kind of level the playing field. Here's one big elephant in the room, though. Good old Michael Saylor for Bitcoin. Obviously... I saw that. So he bought, a lot more today, continues to kind of DCA his position and hedge down. He even said on a recent podcast or some, talk show recently that, if it drops to 8,000, they'll refinance the debt and kick it forward. And a lot of people were like, wait, what the fuck are you talking about? Like, that is bankruptcy written all over it. Again, just like your last endeavor. To me, that was really a bad look in exposing to him and his mindset, their model.
I told you he'll ride that thing into the ground because he's already done it.
You did. You've been saying this from day one before, like you
post from a year and a half ago on my Twitter where I'm like, no, Michael Saylor's not a trustworthy person to follow, and he talks a lot smarter than he is. He says big words and sounds very eloquent.
Yeah,
but he's BK'd a massive company and lost people millions and billions of dollars. So it's not as good as it sounds.
So how big of a threat is someone like him to maybe not just the crypto industry, but Bitcoin specifically, in your opinion?
Well, huge, because he has such a concentrated holding with him and his company that if they have to sell, not only will it drive the price down from a data-driven way, they're selling, so it's going to move the price down because they have so much.
Yep.
Sentimental-wise, it's going to wreck the market because people look at him like the Jesus of Bitcoin, I think, now. And so if he's selling, then I need to sell because there's no longer anybody else that really believes in Bitcoin as much as Michael Saylor that I know of. So that would completely wreck the Bitcoin market, and it would cause a pretty big turn down in
Big time.
In the crypto market as a whole. But I think a lot of that money would come out of it and stay in the crypto space and go to different places that were not Bitcoin related, and probably the place they would go is Ethereum.
Yeah.
That'd be my guess.
I agree. I think there's I'm not as, to your point, I'm not as bearish on Bitcoin as you are, but I'm definitely not as bullish as most people are. And I think there's a lot more alpha plays beyond Bitcoin that I think are a little bit, let's call it the risk reward ratio being much more opportunistic and appetizing. But again, being that it's the grandfather, it's the original OG coin. I mean, I think there's a lot of, again, sentiment and data that can support why it's great and how it can become what it, is perceived to become and is in many ways. But things like that, I think, are little cracks in those stories that I'm definitely paying attention to. Wrapping up on crypto, X is launching a native crypto trading on the platform. They got over 600 million users. As of, I think, yesterday, Elon Musk announced that X was going to launch crypto trading directly from the timeline. This is expected to happen within a few weeks. And most people are, in my opinion, I think, underestimating the impact that this is going to have on the industry as a whole. To me, it may signal that they're either front running, the Clarity Act getting solidified, or they already know it's going to get solidified, or whatever it may be. I think this is a good sign for crypto when you got someone like Elon kind of getting into the space. Again, he doesn't go anywhere that he thinks is not going to have an impact or make money. Obviously, they have 600 million monthly active users, which is 50 million more than global crypto users. So they're going to bring a lot new attention and potential users into the space. In several countries, X is the most visited social app and has 1 billion total downloads. Compare it with any crypto exchange, X is by far the biggest platform which will provide crypto trading. Elon Musk, his other companies like Tesla and SpaceX already own Bitcoin, and now X is going even deeper into that space. Again, I know a lot of people are going to be like, "Oh, it's pumping to the moon." Like it's the beginning of the parabolic, rise. I wouldn't go that far. But I think this is something to pay attention to over a long period of time. Just like ETFs didn't start a bull run immediately, and them coming into the space, I do think this announcement will help attract more attention, more retail interest. So I'm just curious, what are your, thoughts on this? If distribution, as we know, is a very big part of many industries, does X become the largest on-ramp for crypto overnight? And what do you think their impact on the industry is going to be?
I think that's going to be interesting because I have never seen a custodial approach to a social media platform.
That's wild, right?
I have no idea. I think it's going to be successful, but I don't know how successful. So we'll see. I think it has a very high potential, but I don't really have an opinion on how much because I don't have any reference point to go off of, like, who is doing that. No, nobody really. So I think that it's very interesting. I think that it'll redefine the space even more and bring a social aspect even more so to investing.
Yeah. All right, we're going to wrap up on real estate. U.S. housing market has reached its most unaffordable level in history. I don't think this is any news to any of us, but it is
To me,
interesting to hear more and more people really start to become aware and upset about being priced out of the market.
Yeah. A lot of those people are the same people that have opportunities to get into it and didn't because they said that they were priced out of the market. And so that you have to, I feel bad to a degree, but I'm also like, well, yeah, but you also did it to yourself. All you had to do is take a leap of faith, and you just are always the person that climbs to the top of the rock and then talks himself out of jumping off.
100%. Yep. I mean, the question is what is creating this problem, right? Is it a demand problem? Is it a supply problem? Is it a financing problem? I
Mind.
Say it again.
Well, people think themselves into situations that don't exist. Instead of taking risk where there's reward, then it's, if a bank approves you, they're pretty smart. They have a good idea that you can probably pay your mortgage. You just have to make the decision that you're going to do something different and scary. It was really scary when we did it, especially the day after my wedding, when we bought and closed on our first house and moved in. It was the most expensive thing we'd ever committed to. But we did it. And I wouldn't be sitting in my house right now if I didn't. So that's the reward of taking calculated, educated risk. And my income was, around the $200,000 a year range back then. It wasn't crazy. So big risk, calculated, understood, and quantifiable that I could get it done comes with the reward. And that's what you have to do in real estate, especially for your primary residence. You can't be afraid to commit to a mortgage payment, just like you're not afraid to commit to somebody else's with a rental payment.
I think a lot more people are questioning whether or not that risk is worth it, right? I agree. If you feel like the risk is worth it, you got to be willing to take the risk, just like anything. Like if you feel like the risk is worth unlocking financial freedom, you got to invest in stocks. You got to invest in real estate. You got to set up a life, and like you got to take risks to get to the promised land of whatever outcome it is that you have a vision set forth on achieving. Right? I think this is a really interesting time in the history of real estate and just affordability because it somewhat is a perfect storm. We have dampened demand. We have still somewhat of a supply problem, and that's not just with existing homes. That's with builders having a lot of headwinds with material costs, labor costs, with financing challenges, the cost of capital and debt, right? We talk about leverage being a key component in the real estate industry and building wealth, not only on the industry side, but on the investment side. So like, what is it that resets affordability? Is it prices? Is it rates? Is it income? Well, we got to find a way to drive income up for the average person who's going to be able to afford these more expensive mortgage payments or more expensive entry prices for homes. Obviously the cost of capital and what's going on in the banking world and the Fed. So there's so many different interesting variables that I do kind of feel like, I wouldn't call it the perfect storm, but it's a lot of things that when you really go down the list of like all of these things are in this recipe of this outcome, they're all there. They're all present right now. I know obviously Pulte and Trump and the overall administration, the Fed, they're all, let's call it, making an effort to try and tackle this problem. The challenge with this industry is, pressing some buttons and pushing some paper and pulling some levers. This is the cruise ship trying to make turns, not the speedboat. And therefore, these things don't happen quickly. So I'm hopeful that some of this stuff will start to flush itself out. I think this is probably the start of some of these things becoming a little bit more present in the equation, that we'll start to see how they are impacting, if at all, or if significantly, that will hopefully start to impact more of a macro sentiment and some movement. But I still think there's unfortunately some runway and some time that needs to, take place in order for us to have a little bit more of a concrete idea of how the overall real estate market is going to play out. But right now we're still seeing, foreclosures are slowly starting to tick up and defaults. We are seeing, some of the restructures and takebacks slowly start to tick up. And again, I think this is kind of that time frame, post 2020 to 2022, when things were frothy and sexy and everything was great. And like, no way are we going to see ourselves where we see ourselves in 25 and 26.
Yeah.
Back then, that are now getting to the place where people are being forced to make decisions, starting to have to really think about some stuff, are really, facing some challenges, and they're kind of holding on for dear life. And the ship is either sinking, or you're going to have to do something and take a lifeline and do something a little bit differently with your deal. So I think obviously in challenges like this, I'm always an opportunistic, optimistic type of individual that goes like, hey, when there's challenges, unfortunately, this is your time. If you're creative enough, proactive enough, aggressive enough to go out and help people solve problems and also get rewarded for it. So we'll continue to track that and kind of see how that all plays out. But very interesting. Here was an interesting headline this week that I don't know how to feel about it. In California, strangers are legally allowed to sell food out of their homes in Gavin Newsom's California. As of this last week, we saw one of LA's most talked about coffee shops right in someone's home kitchen. It's real. They're allowing it to be legal. No business permits, no food inspector coming into your kitchen, and all the shit that they make small businesses do, and all the red tape and the hoops that they make them jump through, and all the commercial owners that they make, abide by the laws and the permits of, getting those tenants and those businesses in there to be patronized by local citizens. They're just, fuck it, I guess. No restaurant zoning, no commercial build out, no neighborhood vote. Just absolutely wild to think about. This is the same state that shuts restaurants down over paperwork. If you had a vaccine card, buries small businesses and fees and permits, screams nonstop about public safety and health and diversity and all of it. But all of a sudden now, they're calling it community, they're calling it connection, which again, hey, like, I'm cool with that. If that's what we're going to do, like, if you want to choose to go out to, neighbor Sally's house and get, a ramen bowl, or you want to go down the street and get a really cool, latte, like, I'm cool with that. But that better be like the set of rules across the board for everybody, instead of, absolutely crushing the people who have been taking risks and are doing it the right way. And then you're giving the backdoor deal to other people to do it a completely different way. Very interesting to see. So I don't know if you saw that, but I thought that was a wild headline.
I didn't see that, but it's not surprising because California does a bunch of weird stuff.
Yes.
Thank goodness for the weather.
Yeah. Right. Well, even with U.S. home sales falling 8.4% in January, which is the biggest monthly decline since February of 2022, we are still seeing an overall healthy level of demand and absorption in markets across the country. So we'll continue to track what's going on in the real estate market. As always, we appreciate you guys tuning in each and every week. If you've got questions, comments, thoughts, shoot us a text, 844-447-1555. We've got the videos up now on YouTube and Spotify, so don't forget to check it out. Subscribe, tell a friend, anybody that wants to get that pulse on the financial markets and elevate and raise your financial fitness. We'd love to have you tuning in each and every week. As always, if you want to connect with Ryan and his amazing team, text the word X-ray to 844-447-1555. If you're a passive accredited investor and you want to chat with me and my amazing team on the investment deals that we have or our income fund for hard and private money lending, you can text the word deals to 844-447-1555. As always, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Visual.